first macro webinar for 2025 here in January, the title of which is Curb Your Enthusiasm. When we've gone into the last couple of years, 2023 and 2024, expectations were very low for the real economy. It wasn't that many that long ago when when people looked at expectations of U.S. growth coming into 2023, and the expectation was 100% probability that there would be a recession within 12 months. And while entering 2024 wasn't nearly as weak as that, we still had a situation where expectations of U.S. growth were still around 1%. Now, in both 23 and 24, the U.S. economy was stronger for longer than many people had expected. Our view that the economy would be more resilient to interest rate hikes was non-consensus a few years ago. And what I'd emphasize is that today, strength in the U.S. economy on a forward-looking basis is consensus. And you see that in the chart on the left-hand side, where entering each year in 23 and 24, you saw very low expectations and a big outperformance. And now we basically have reset expectations for the U.S. economy to be about as strong as it's about as strong as you'd possibly expect. And so entering 2025, it's a very different set of expectations today than we've seen entering the last couple of years. And that's important because when you think about investing and you think about what drives asset returns, the actual macroeconomic fundamentals are not the things that drive asset returns on a forward-looking basis. The thing that drives asset returns is how conditions come in relative to expectations. And so if we had very low expectations in the last couple of years, the economy outperformed that, and we saw stock market rise in response. When you enter this year having expectations as high as they are, it's going to be a lot harder to surprise to the upside and sustain the types of equity market appreciation that we've seen in the last couple of years. Now, those strong expectations, they're not just, economists' expectations of growth. They're also in a variety of different other places across financial markets. So on the right-hand side, what you see is expected S&P 500 earnings growth, which, for a while there, we're running at about 0 and ticked up here in 2024 a little bit to be growing around 5 to 10%. But what we see is we look at analyst expectations penciling out for the next year is that by the end of this year, year over year, earnings growth is expected to grow at 17%. That is very, very strong earnings growth, particularly in a late cycle economy. Now, of course, that's modest, almost always modestly overstated, as analysts overstate earnings growth expectations. But still, even if you were to haircut at 3 to 5%, which is the typical overstatement, you're still looking at mid-double-digit earnings growth expectations from analysts. That's a very, very elevated expectations and much higher than what we've seen in the last couple of years. Similarly, on a longer-term perspective, sentiment is very, very elevated when it comes to the U.S. equity market. PEs, people talk about how today companies have much better earnings than they did back in the tech bubble. But PEs take into consideration, if anything, PEs take for granted what's on the right-hand side here, which is another 17% growth in earnings over the course of the next year. Even with that under consideration, PEs are at essentially all-time highs just off of where they were in the tech bubble. And so you're seeing short-term expectations of growth very strong, long-term expectations of growth very strong. Essentially, equity markets are pricing in a boom in the U.S. economy ahead, unlike anything we've seen in the last couple of years. And it's not just in the stock market. We look at what's priced into the rates markets, increasingly unwinding in the last couple of weeks, unwinding expectations of Fed easing happening in 2025. At this point, we are way above what the SEP was, certainly the September SEP, but even the December SEP. And you see here in the spread markets that spreads are have continued to tighten, and high yield spreads are essentially at all-time lows. The last time we saw this was right before the financial crisis. And so a couple of other markets where you're seeing expectations of US growth being very strong. We look at the real rate market, you see basically the same thing, which is real US real rates now pressing to the point where they're basically back to the types of levels that we saw in the pre-GFC boom period, and we're starting to see term premiums rise to their highest level in the post GFC period, all of which are in line. The combination of the stock market and the bond market moves that you're seeing here and spreads paint a picture of very strong future growth expectations in the US economy. Now, some people look at what's going on in the bond market and they think they'll emphasize that might have something to do with concerns about the fiscal position in the US, or concerns about inflation. And if that was the case, you wouldn't see this combination of market action. If there were meaningful concerns about the fiscal position of the US, what you'd see is you wouldn't see stocks going up and bond yields going up at the same time. That's a pro-growth pricing. All of this is aligned with a pro-growth pricing. Similarly, you wouldn't see the dollar going up while bond yields were going up if there's a real concern about the dollar, right? If there's a real concern about the dollar, you'd see bond yields going up and the dollar going down, right? And we've seen the dollar relative to other fiat currencies trade up considerably, and we've also seen it, hold in there, pretty stable against gold over the last couple of weeks as well. So this really does not look like a dollar concern or an inflation concern. This really looks like a lot of very strong pro-growth pricing priced into into U.S. financial markets. And this is all happening at a time when when the most cyclical parts of the economy are weak and starting to weaken relatively materially. The manufacturing sector, has been weak for a while. That's what you see over here on the left-hand chart. And on the right-hand chart, what you see housing, which had held in there a fair amount, in part because of a significant backlog in terms of new units getting built and delays in terms of their production. Now, units under construction deteriorating essentially as rapidly as we've seen in several decades. In addition to that, some of the other areas that had been holding up growth for a while, so construction spending, both commercial construction related to office buildings and things like that, was holding up and fell more materially starting in 2022. But the thing that had been holding overall construction up was manufacturing related construction. So, things related to the CHIPS Act, et cetera. And that investment had been growing very strongly. And that too moderated in the second half of 2024. And so that sort of picture of, housing construction holding up the economy despite high rates, manufacturing construction holding up the economy despite high rates, and fixed investment in structures, that's what you see here on the right-hand side, holding up the economy despite high rates. All of these things are starting to roll over and are basically the weakest they've been in some time. And so when you add it all up, I was actually looking at a chart that Prometheus Macro was sending out earlier today. It basically said U.S. growth is entirely household consumption at this point. That's all there is to it. It's just household consumption. All these other factors, which had been important in extending the strength of the U.S. economy, they're all starting to fade. And now the entire U.S. expansion is borne on the shoulders of continued household consumption. Now, those of you who have been following me for long enough are probably bored to tears by me stating that this is an income-driven expansion. But this is an income-driven expansion. And now that household consumption is basically the primary driver, essentially the only driver of continued growth, what happens to incomes will be a critical driver of what is going to happen, how we're going to see the economy play out. And I think that's important because when you look at what's going on in the labor market, we're clearly seeing some loosening of labor market conditions over the course of the last 6 months, and some indications that this may be weakening a bit more materially than than you know than is uh, than is needed in order to continue to have this expansion continue. So what you see in prime age working share, had been at highs for a while and weakened a little bit. You see employment growth here on the right hand side. Now this is a combination, this is averaging the payrolls report with the household survey, which for a variety of reasons is likely a better way in combination to look at it, is more accurate than to look at each one of them independently. That also has weakened considerably. Now, it's not weak. It's just a question of how are we going to get to this number, right? This is what we're getting. This is what's expected, which is, 2.5-ish% growth. How are you going to get to 2.5% growth when a lot of the supports that are going and this extremely strong earnings growth, when a lot of the supports that exist, that have existed, that were supporting the economy are fading, and where you're starting to see pressures on households. And what you see here is, ultimately what is going to drive this expansion, this continued expansion from here, is highly reliant on households continuing their consumption. So they need to continue to get the income from from employment, and they need to continue to spend out of that income growth in order to keep nominal growth continuing. And we've been in the last couple of years, we've been kind of in this holding pattern where labor markets have been tight enough to create enough wage growth, to create enough nominal spending growth, and asset prices have continued to rise enough to keep households running, a savings rate which is certainly below where it was pre-COVID, not falling rapidly, but this is not a particularly elevated savings rate. And that creates a lot of fragility because essentially, if the income side of the equation falters at all, particularly from those more cyclically sensitive sectors, then you have a risk that the income coming in, the income growth that's coming in, will slow, which will put a weight on household incomes. And similarly, it highlights the fact that continued household demand at these levels is very reliant on continued asset price appreciation. The reason why households have been comfortable essentially spending 100% of their income growth on an ongoing basis is because asset prices have kept going up, which meant that the incremental need to save has not been that high, right? If your stocks are going up, your 401k is going up 25% a year, and your house price is going up, 10% a year, you don't have the impetus to save as much as if those asset prices are not going up in that way. And so this economy is very levered implicitly to a continuation of rising asset prices to maintain the household spending that we're seeing, which is being financed by the continuation of tight labor markets and income growth. And so you put that all together, and in a lot of ways, expectations are very high for growth. The only source of growth at this point is coming from household consumption. Household consumption is reliant on continued uh, strong asset prices, and strong asset prices are really reliant on not having bond yields rise too much. And that is the challenge with what we're seeing right now, which is that all of what you're seeing today is a set of dynamics that were in motion in the data. What you're seeing today in the data is a set of dynamics that were in motion set about 3 to 6 months ago when it comes to hiring, spending, etc. But since that was set in motion, we've had over the course of the last 6 or 8 weeks more than 100 basis points rise in interest rates. We've effectively had 100 basis point plus market-based tightening, which is yet to flow through and yet to be seen in the underlying stats. And so that's what I'd emphasize, is that we're seeing the maximum exuberance in terms of asset prices of future economic conditions just at the time when we're starting to see, we've experienced one of the largest market-based tightenings over the course of the last couple of years. And that's going to take time to play out. In a lot of ways, the strength of the economy created the shift in bond yields, which created the market-based tightening, which is undermining the future growth expectations. And we're just seeing the start of that. The idea that we've transitioned from equities rising pretty consistently for 2 years to the last, 3 or 4 months where equities have flattened off. Today's equity prices, S&P 500, is where we were back in October, right? So now we have 3 or 4 months where asset prices have basically been flat, and down from peak at this point. Like, you see that transition. We've transitioned from a world where, everyone's a genius, all asset prices are going up, and consumption continues, and euphoria reigns, to one in which rising bond yields combined with slowing asset price appreciation and weakening cyclical sectors and some concerns in the labor market are setting up for the probability of a worse set of conditions, certainly relative to those euphoric expectations ahead. And this is totally natural. This is how macroeconomic cycles work, which is that there's always ebbs and flows in terms of expectations around what's likely to transpire. And oftentimes, whether it's rising yields or higher expectations, that that strength of the past sows the seeds for weakness in the future. And we look to be at one of those turning points. And if you go under the hood, you can start to see some of this weakness exist in some of the growth stats. So you see, the Bloomberg Surprises Index rolling over at a time when bond yields continue to rise. I think, if you look back through time, this isn't a one-for-one thing, but in general, when you see growth stats come in below expectations, you typically see bond yields fall. We have yet to see that, where there's a lot more focus on certain stats and certain elements of certain stats that is keeping interest rates elevated. And if you look back over the last couple of years, this typically catches up with itself, and you're seeing the actual stats that come out being weaker than where we were earlier in the quarter. On the right-hand side, the GDP Now estimate, which is important to recognize that what you're seeing is this line is showing you an average of the expected average GDP growth for the fourth quarter. And so in particular, when you start to see that trend line go down based upon the most recent data, what that suggests is the most recent data from a growth rate perspective is weaker than what the data was earlier in the quarter. So it's giving you some indication of some downside momentum in the economy. Now, a lot of folks, I was just looking at this earlier today, will point to things like the NFIB and an overall set of optimism to point to positive outcomes ahead. Leave aside the fact that from an empirical perspective, just for instance, the NFIB, the subsequent equity returns when NFIB optimism is high are, if anything, somewhat negatively correlated to each other. So leave that empirical point aside. Optimism is not economic conditions. And I think it's really important. Optimism does not mean that you're going to get better economic conditions ahead. I think it's a really important dynamic, one which is in particular undermined by the fact that nearly all of these surveys that you see around, really any expectations survey or any optimism survey are highly influenced by partisan behavior. Now, we know that the composition of the NFIB survey panel is tilted towards much closer to Republicans than tilted towards Republicans rather than Democrats. And so it's not surprising that we're seeing, in response to the electoral outcomes, a surge in optimism from those who are more heavily weighted to the party affiliation that won the election. You see that also under the hood in things like the the Michigan survey, the Michigan Confidence Survey, or here on the right-hand side, this is from the Morning Consult, which is a timely daily survey of consumer sentiment. Again, what you see here is big upward adjustments in terms of Republican sentiment, and down and significant, but not nearly as big downward adjustments in terms of Democratic sentiment. Now, if you go back and look at this through time, you might say, hey, look, who cares why the sentiment is positive? People might engage in more economic activity. And what you see is that actual economic activity is unrelated. When driven by partisan behavior, when sentiment's driven by partisan behavior, actual subsequent economic activity is unrelated to that sentiment. And so what we're seeing here, whether it's inflation expectations, whether it's consumer sentiment, et cetera, whether it's NFIB, these are all reflections of partisan outcomes and should largely be discarded as indicators of what's likely to transpire with economic conditions. Now, that's not to say that politics don't influence and political policy doesn't influence what's likely to transpire in the economy. It just means that sentiment is not the primary driver. What will matter is the policies that ultimately get adopted by the new administration and Congress. And there, what I'd emphasize is that there still continues to be a great deal of uncertainty about what exactly the policies are that are likely to be implemented. I mean, even today, we've gone through, in the last 24 hours, we've gone from gradual tariffs to fast tariffs to gradual tariffs. I mean, who knows? Really, who knows what is going to be implemented? There'll be a lot of people, and I'm sure folks hear a lot of people with very strong opinions about what policies will be implemented, how they'll be implemented, and what the effect will be of them when they're implemented. And what I'd emphasize is that a lot of probably what you're hearing is partisan rhetoric rather than understanding. Anyone can have a confident opinion on anything, right? It doesn't mean that that's actually how this is going to transpire. And so I think the smart money today is recognizing the uncertainty of the policy environment that's likely ahead. And we'll wait and see how policy transpires, what actual policies get implemented and what are the and then understand the macroeconomic consequences of those actual policies instead of trying to think two steps ahead in terms of an environment where there's still a lot of uncertainty. So this policy mix, if you take this as a menu, this is essentially drawn from the campaign rhetoric that you see on the screen, could range anywhere from a pro-growth disinflationary policy mix, which would have certain effects, to an anti-growth inflationary policy mix, which would have diametrically opposed effects. And predicting which one will go down is a fool's errand. If you've been through these cycles enough, what you realize is if you go through a process of waiting to see which policy actually gets implemented, and you better understand the macroeconomic consequences than how other people understand it, then you're going to be in a position where you'll be you won't be swung around by the incremental noise of the policy making, policy sausage making, and you'll have a much better understanding of the impact when those policies are much clearer. I mean, the reality is, if I think about where we are in this cycle and really where we've been over the last couple of years, is we've been through a bunch of different periods of extreme sentiment in one direction or another. I like this chart of the 2-year bond yield because it kind of gives the feel of what it's felt like over the last couple of years, where we've gone from periods of certain recession and economic weakening to periods of certain boom and economic strength and inflation. And if you've gone through this dynamic over the last couple of years, these different swings, it's been much better to fade extreme sentiment than it has been to chase extreme sentiment. And in part, that's because, this sentiment undoes itself. The more people expect an economic boom, the higher interest rates are, the more weight on asset prices, and the more disappointment ahead. And similarly, the more concern about the economy or about low inflation, the greater the interest rate declines, which then creates an effective easing moving in the other direction. And when I look at what's going on in terms of asset prices today, what I see is we're in another one of those moments of extreme expectations. In this case, the euphoria of the strength of the U.S. economy ahead, combined uh, with a lot of with very high expectations of the type of pro-growth policies that are likely to be implemented by this new administration. Now, of course, um, as an American, I'd love to see pro-growth, disinflationary policies. That would be better off for everyone. But as a market participant and investor, your hopes for what policy will come cannot cloud your judgment on the probabilities of what policies will likely occur and the economic consequences of those. And at this point, markets are basically fully pricing in uh, the best possible scenario for underlying economic conditions, for equity earnings, for long-term growth in the equity market, and for the policy mix that's ahead. And when you see that type of dynamic, you typically you typically want to fade that because that is too high of the certainty is too high relative to the probabilities that it'll come. And so when you're thinking about asset prices today, what that means, in general, is that favors bonds relative to stocks, particularly and increasingly as bond yields rise, undermining the probability that you'll get the type of growth conditions that are played out, which in many ways is the exact opposite of the outlook that we had a year ago when our pitch was stronger for longer. And that played out exactly as we basically expected in the first quarter of 2024. So um, all that comes down to is this basic framework of how are conditions likely to play out relative to what is priced in. And today, what is priced in is euphoria. And that is much less likely to happen than what is currently expected.